In recent years, central bankers have spoken to us about a narrow path. Jay Powell has talked about the narrow path that he is attempting to achieve for the US economy. Michelle Bullock has told us about the narrow path for the Australian economy. What is the narrow path? The narrow path is slowing down these economies at a rate which generates what is called a soft landing. A soft landing is slowing the economy and pushing up unemployment, but still maintaining growth in the economy. Some economists talk about this as being a growth recession. Growth slows to low levels. It is still positive, but it's enough to push up unemployment. Why do they want to push up unemployment? They want to push up unemployment because as unemployment rises, that puts downward pressure on wages and inflation will fall towards their target of around about 2%, 2.5%. So how is Australia going in this pursuit of the narrow path? Well, the last GDP numbers were a bit of a received as a nasty surprise by the public because growth slowed for the year to March to only 1.1%. But in terms of pursuit of the narrow path, that's really where we want to go if we get to achieve a soft landing in the Australian economy, because the average growth rate for the Australian economy for the last 20-some years, since the beginning of the century, is 2.8%. Since the beginning of this decade, or the previous decade at 2011, the average growth rate is 2.6%. So we're slowing from that average growth rate down to 1.1%. That's, as we slow, that allows unemployment to rise. Now, some mates might say, when they looked at the March quarter GDP with that slow number of only 1.1% growth, that inflation in terms of the GDP measure for inflation had already fallen low enough. But the reason that fell was not because domestic prices fell or because consumer prices fell, but because commodity prices, the commodities that we export, fell. And they fell by 7.3%. For the year to March. Whereas no RBA in its right mind would put up interest rates in a situation where growth in the Australian economy was 1.1%. No RBA in its right mind would cut the cash rate in a circumstance where the GDP deflator was falling at 1.1%, because that's not the target that the RBA is attempting to achieve. What it's attempting to achieve is 2.5% on the CPI. Where do the most recent CPI numbers tell us that the Australian CPI is now? Well, on the quarterly measure for the year to March, core inflation, measured as the trimmed mean, increased by 4%. That's well above the 2% that the RBA is trying to get. For the monthly number for the year to April, that trimmed mean increased by a slightly higher 4.1%. So this is well above where the RBA wants to get our inflation to. As I say, no RBA in its right mind is going to increase the Australian cash rate with growth of only 1.1%. But no RBA in its right mind is going to cut the Australian cash rate with a monthly trimmed mean or core inflation of 4.1% when our target's 2.5%. So what's going to happen is that rates are going to stay exactly the same. Our model of the Australian cash rate, which explains 89% of monthly variation since way back in 1990, tells us that right now gives us a model estimate of 4.22%, which is almost exactly where the actual cash rate is, of 4.35%. So we think the Australian cash rate is not going to go anywhere next meeting or the meeting after or any meeting this year and perhaps no meeting until the middle of next year. And by that time, inflation may have fallen to a point where the RBA can cut cash rates. But right now, cash rates will stay on hold for the next 4 quarters up until the middle of 2025.